So good evening to all of you, the wonderful participants, and our speaker for today, Nishtha Khurana, the Chief Risk and Compliance Officer, MMTC-PAMP India Private Limited. We are indeed very fortunate to have her with us because the topic is a bit different. Elevate risk management using analytics. Some audit systems and softwares Private Limited is really pleased to bring the Analytics Wednesday online webinar series. This is the 42nd webinar which is being held, because we hold it every Wednesday 7 p.m. to 8 p.m. live, which is streamed on YouTube and then recorded and is available for people, professionals, to have a look on the Sama YouTube channel. So that's really great to have great speakers come in and share their experiences and talk to us. And it's really good for as a professional activity to reach out across to the professional fraternity in the country and even abroad. Today's session, which is there, is a little bit different because we're talking about elevating risk management using analytics, using the experience that the speaker brings to risk management, internal audit, internal controls, etc. The entire range of issues which are there. This session is also supported by the Government of Canada Trade Commissioner Service, and I will formally, without taking much time, and going into, we always talk about some audit, but today let's launch directly into what the speaker, understand what the speaker has to say. So I'll formally introduce Nishtha to all of you. So Nishtha is a chartered accountant with 20 years of experience in risk management, internal audit, SOX, internal controls. She is currently working as the Chief Risk Officer and Chief Risk and Compliance Officer, MMTC-PAMP India Private Limited. In her current role, she is handling overall risk management, compliance monitoring, as well as ensuring preparation of the annual audit plans and execution of the internal audit also, over monitoring the execution of internal audit. She is part of the executive board of the company, and she is part of the various committees, the risk committee, risk and compliance committee, audit committee, internal complaints committee. She's part of the executive board of the organization. Previously, she has worked with reputed organizations like Home Credit India Limited, Home Credit India Private Limited, as head of internal audit, the RBS Group, where she was involved in risk reporting and analytics and in setting up the operational risk framework within the group, and Deloitte, where she handled assignments ranging from internal audit, SOX readiness and compliance, ITGC audits, business application control assurance audits, enterprise-wide risk management assignments, SOP re-engineering assignments, etc. She completed, I think what is notable is that she completed a CA at a very young age, 22 years, which is a itself achievement. And she also completed a master's from University of Applied Sciences in Berlin, Germany. So that's something different usually, what she has done. And she won the DAAD Best Student at FHTW Award. Maybe she can just explain that, to all of us. And she has completed a graduation, of course, in BCom from Shriram College of Commerce, Delhi University. And she's also attended and successfully completed the Embedding Leadership Excellence Program at the Indian Institute of Management, IIM Bangalore. IIM Bangalore is very close to my heart because I've stayed there for a number of times in the last 10 years. So it's a beautiful campus and a very nice learning center. Moreover, she is a certified facilitator, having cleared the effective facilitator certification from the prestigious organization Leadership Strategies with Flying Colors, which helps the teams to build audit KPIs across all the businesses for measurable audit performance. So I think, in short, a very, very great, CV which we have seen there, her bio, her list of achievements. So over to you, Nishtha.
Thanks a lot, Deepji. FHTW is basically Fachhochschule für Technik und Wirtschaft, which basically means University of Applied Sciences in Berlin, in German. Right. And I was the university topper in my course over there. So that's why I received that award. So, yeah, so I've dabbled in a lot of things when it comes to academics. I've been I've done CA, I've done MBA, I've done leadership programs, I've done facilitation certifications, and yeah, so it's been a variety of experiences, both in terms of academics as well as professional journey. And today I'm going to share something that is embedded in the entire professional journey of mine, which is about risk management. And I started about 22 years ago, where we started with traditional internal audits, which was basically voucher checking and things like that. We slowly moved to risk-based internal audits. And from there, we started working on a lot of things related to risk management, operational risk policies. We worked on a lot of things related to risk management life cycle building in a company. So dependent on a lot of risk management tools, and most of them use analytics. So even if I myself have not studied analytics, I've been continuously using it throughout my journey in risk management. When I was part of the Deloitte, we used to run various reports, and we used to do a lot of analysis to add value to our assignments and audits. And we used a lot of data analytics even back then in 2003 and 4. And then when I shifted to RBS, my first role involved basically risk analysis. And we were looking at a lot of trend analysis of various business departments and units, comparing their movements from within the risk appetite, and preparing reports for the for Meera Sanel, who was the heading RBS at that time. So she was directly referring to the reports I was working on. We also started developing automated reports, initially using macros and things like that, and then probably developing an in-house software as well. And I used that experience even in the later stages when I was head of internal audits in Home Credit. We started working on a lot of SQL queries for continuous monitoring, etc. I personally don't know how to build SQL queries. We employed experts for that, but we knew exactly what we wanted to derive out of the data, what kind of data we needed. And that is where I bring today's session from. So the session is entirely from a risk manager's perspective who has been using analytics, and not from someone who's trying to, tell you, okay, this analytics will help you with this and all. I'll just be talking about my journey of using analytics while building risk management systems in various companies. So that's where I will be coming from. And I will be covering a lot of topics which will help me explain what I learned throughout my risk management professional journey. I'll give you a very brief introduction, because I believe most people over here already understand what risk is or risk management is. Then I'll talk about very briefly about risk analytics as well. And then I'll talk about how we can use analytics to perform a better risk management or employ a better risk management framework in the company. And we'll talk about what kind of data analytics. We'll talk about what are the steps risk managers need to employ to be able to use data analytics effectively. And so how it will help you. So that's what I'll be talking about today. So we can go to the introduction slide, please. Yeah. Very briefly, what is risk and what is the role of risk management team? Like I said, I believe everyone over here understands risk and risk management team because they're seasoned professionals. Risk is a major cause of apprehension in any company. So by identifying risks and managing them in an effective fashion, now is a major concern. So that is a major concern for any business. So organizations face various internal and external factors that influence and bring uncertainty in operations, and the extent to which they impact achievement of your objectives, that can be classified as risk. And the main role of risk management team, so the risk management team of a company is to be able to help the companies to identify the risks, come up with the plans that will, if not remove, but at least reduce the impact of the risks materializing, and help the organization accomplish the goals in an effective manner. The risk management team of a company is also responsible for making a list of the risks and determining their level of criticality. So, a good risk management policy is therefore essential for ensuring continuous success and growth of an organization. So, we can move to the next slide, please. So now I'll very briefly talk about risk analytics. What are risk analytics? When we say risk analytics, basically what do we understand? Uh, so any like risk analytics is actually the use of data analytics and the analysis of various different information and you know the whole population of data that is available to you to be able to derive useful information that can help you with the risk management in the company, or in order to identify threats to an organization and develop a risk assessment plan for remediating and responding to those threats. Any comprehensive risk assessment, it includes the evaluation of threats to an organization or enterprise. But then again, what tools or technology to use to conduct this analysis? And basically, the part of the answer to that question will depend on your metrics. What are you trying to measure? So data analytics for risk assessments can range from basic statistical modeling using, design phases of a project to sophisticated machine learning models that paint a dynamic risk picture based on large data sets. Like I was part of a company that was extended loans to personal loans and consumer durable loans to various people. And our ticket size was very small, but the number of customers was huge. And any reports that we would run into lakhs of rows. So it was very difficult to do any checks on the basis of sample, because no matter how many samples we pick up manually, we will not be able to provide the kind of assurance we need to be able to derive actual useful data for any kind of risk related decision making. That is where we were using a mix of basic modeling, like we were using a lot of trends analysis, and we were using SQL queries, which helped us to develop some continuous monitoring techniques. For example, if I give you a very basic example, one of the requirement of law is that we need to have at least two KYC documents for every customer. One is the Aadhaar, other is the PAN. So a simple SQL query that was just checking on a weekly basis on all the loans that were extended, do we have these two KYC documents on record or not? It was just giving me an exception report, but within 5 minutes, I was able to check whether I am compliant with the internal control or not. And it was using the data that we already have in our system. It was just running on account numbers and the number of documents and the amounts extended, etc. And it was very basic data analytics, but it was serving our a big purpose for us, because if I were to go and start checking manually whether two documents are there or not, it would not help me in any which way. So just by checking the number of attachments in our system, because the system did facial recognition checks and all, so we already knew that if there are two documents, one has to be Aadhaar, the other had to be PAN. uh, just by doing that check, we were able to ensure the compliance to control. So the right statistical solution can help you better predict trends, and better check adherence to controls and outcomes, discover potential risks to an enterprise, and also prioritize action in a risk management plan. So yeah, we can go to the next slide. Now, why is risk analytics important? Like I said, it can help you to predict trends and outcomes, discover potential risks, and also prioritize action. So, what risks are higher in impact or in rating for me? I would obviously prioritize action for that. But sometimes it may need some other additional information which is available to me. Uh, from the data that I collect as part of the audits or monitoring risk management procedures. And this data is also useful for me to identify the kind of actions that we need to put in place. Uh, if it is not giving me the desired results, which again would be visible by checking the data, then that action is useless for me. And by manually putting that in place and then trying it out after 6 months to see the desired effect, it doesn't help me serve the purpose. And regular use of analytics helps you make faster decision making, put in changes where required, modify your actions, and put the right ones in place as well in time. So, yeah, so now I'll talk about the most important part of my presentation: how data analytics can be embedded into the risk management process to help you with the risk management life cycle. Now, what you see on screen is, for all risk manager, this is the core of risk management. These are the 5 stages of the risk management life cycle. Uh, I'll briefly explain the risk management life cycle as well, and then I will talk about how data analytics can help in the risk management process. So we all know that for any risk framework to be put in place, we go in a 5-step approach. We first identify what all risks the company is facing. Then we assess all those risks and prioritize them according to the impact ratings and the risk ratings. We determine the response and the mitigation plan for each risk, like building in internal controls in place and putting in checks and balances over there. Then we monitor the risks to ensure that they are still under our control, that they have not materialized, and that we are able to mitigate them as much as possible. And then we prepare risk reports that are used to share with the management and the other stakeholders, and that are also used to make the cycle go further. That will also help us to identify new risks, emerging risks that may come forward. Now, if I go stage by stage, I can talk about how analytics has helped me in each of these steps. If I talk about risk identification, like for organizations, the risk can originate from internal factors like inadequate processes and controls, lack of funding, etc., and or external environment. So it can be either or it could be both. External factors like political and regulatory changes, climate changes, etc. With bigger and complex industries and economies, unprecedented amount of data is available, and data analytics can help integrate internal as well as external data for identifying emerging risks. We already know what is there in our risk register, but for the cycle to go on, we have to keep looking for emerging risks. We have to keep collecting data from our internal sources as well as external sources, keep analyzing them to identify new kind of tools. So Jerome, can you please click once? Yeah, so these are the popular tools that most companies use to identify risks. So for the risk identification life cycle, stage in the risk management life cycle, tools like analytical tools, visualization platforms, and web scrapers and data ingestion tools are very popular to be used in terms of collating reports and data from internal and external factors that help identifying emerging risks. Now, moving on to the next stage, I'll talk about risk assessment and prioritization. Assessing and prioritizing risks is extremely important to ensure adequate focus of the management on critical areas, like aligning the data to the risk profiles and indicators. It allows you effective profiling of the risks in terms of impact and likelihood, and thus analytical models can be built to detect potential risks, fully assess their financial and other associated impacts, and to create analytical framework that can help balance financial and strategic impacts to mitigate and manage risks. So we are using these popular tools, like I said, these data ingestion, data modules. These tools are used in assessment of risk. And once you're assessing the risk, you are able to identify the severity of the impact. You're able to identify the likelihood of occurrence, and it helps you prioritize various risks. So you're able to focus on the high risks, high rated risks before you focus on the low rated risks. And that helps you manage your overall risk profile better. Next one is comparatively easy to understand risk response and mitigation. An effective risk response, it must evaluate various available options and not only decide the best suitable alternative, but also consider consequential impacts emanated from selected options. And that is where analytics plays a huge role. It also needs to track and monitor the response effectiveness for timely course correction wherever required. So, data analytics can easily be leveraged for this purpose. You can generate various reports to see what action will give you what results, and then you can decide which action is your best course of action for to mitigate a certain risk. And sometimes it so happens that you're able to identify more than one course of actions, but then you also need to prioritize within those actions that which one will help you better to mitigate and which is a good to have. So that is something where we use a lot of artificial intelligence, machine learning models. We use scenario models, or and even like building controls. Use a lot of workflow tools. You use analytical tools and visualization platforms. Then risk monitoring, again, it is simple, timely, and robust risk monitoring is critical in today's dynamic environment. We all know that. Identification of key risk indicators for each of the risks is important to measure the trends. And that is again where all these analytical reports and results of various actions we have taken come in handy. So once you have the results of what you've done, how it is helping the business right over there for you to see in front of you, you're able to identify where course correction is required on a timely basis, where some action items are not working. In that case, you can put in new actions in place, or you can entirely change your approach to mitigation of that risk as well. And the last stage is about risk reporting. Timely and relevant risk reporting can be achieved by embedding the entire risk management life cycle on an integrated technology platform, which can give you scheduled and on-demand reports, enable real-time views of risks, and helps in keeping a track of past learnings. Like I was giving example of how we were using SQL queries in my previous company for IFC purposes largely, so internal financial controls, where one of the things that we have built in the framework was monthly and quarterly testing. So the regular controls that were daily controls, and wherever it was possible to write SQL queries to give us results and exception reports, we were using them regularly. And we were not even waiting for month end or the quarter end to run those reports. Those were run on a weekly basis. Timely exception reports were generating actions for us, and even if there were no exception reports, it was really a great comfort to know that your controls are functioning well. And we used to call that continuous monitoring. So they were SQL queries, they were run on a scheduled basis. Every morning or every time they were run, we would get reports that were displayed to us on Power BI, and we were using those dashboards even in the reporting for to the management to tell them that these are the ones, these are the trends that we have been observing. For example, we were looking at credit life cycles. We were looking at we were assigning scores to the customer due diligence. We were assigning risk groups to the kind of customers that were overdue. So if you come from the finance company, you understand first time missed payment, second time missed payment, and third time missed payments, and each of them are handled in a different manner. So we were assigning trends to each of them, and we were using a lot of those reports for risk management. We were using them for credit risk management. We were using them also for operational risk management. We were using them for audits. We were using them for internal financial control monitoring. And so these kind of tools, these tools, ACL queries, then there's idea, there's tableau. These are widespread in the companies nowadays. They run queries for you, they provide you dashboards, and you can use those reports to monitor the risk life cycle. Yeah, so this is largely how you can actually embed analytics in all stages of risk management. Now, now the next question normally is, what are the types of data analysis that risk managers can use? So Jairam, we can go to the, yeah. So like I said, we were quoting popular tools over there, but all of those tools are basically categorized into four categories, which according to me will define how to choose a tool. Basically, there are four types of data analysis that the risk managers need. They can need a descriptive analysis, they can need a comparative analysis, they can need a trend analysis, and a little less used is visual analysis. It is used more for reporting, but it is still a type of data analysis that risk managers often use. Now, what do I classify as a descriptive analysis? A descriptive analysis basically creates metadata, namely data about your data, like access logs, change logs, and things like that. It explains what is going on behind the scenes and what created the figures you're looking at. What has happened over time in the organization, what are your costs, revenues, etc. What has changed over time, like I gave you the example of change logs. And what you can do to positively influence these factors. For example, you're looking at access logs, and you're doing user access right reviews, and you're looking at access logs. You compare the access rights of people over time, and you realize the roles have changed, but the access rights are continuing the same. Is it really required? So these are not related to numbers, but these are still very useful data analysis checks that you can employ as part of risk management. Normally, when we talk about data analysis, it is understood that finance people are using it. How are the risk people using it? Risk people are using it in a lot of different ways where it does not even involve numbers. Change logs. You identify what all changes have been made to the system, to the IT system, to the networks, to any business application, and then you can use that logs and change reports to identify which were critical changes. Had they taken care of the entire change management process, it can help you in sampling and identifying where all you need to employ your checks to ensure that the risks were covered. And these are the basics. Every risk manager is using them, even if they don't understand that it is actually data analysis that they're performing. But this is basically what all is going behind the scene that is giving you what you can see on the books of accounts, you can see on your maybe employee masters, or what you can see in your customer front facing applications. But what is going on behind the scenes is what we can employ as and describe as descriptive analysis. The next one is comparatively easier. It's called comparative analysis. So you need to understand that data is never isolated. A data on its own serves no purpose. You can just pull out a report, but it will serve no purpose unless you use it to identify something. So data is never isolated. It results from a variety of interlocking factors and scenarios. While it can be helpful to view an individual piece of data, studying how it relates to other figures can give you more insights on cause and effect within your organization. A very basic example here, which is employed by the finance department in every company, is budget versus actual analysis. So you're comparing your budget with your actual spends or capex or whatever, and you're trying to derive where you have gone overboard, where you have saved costs. And as a risk manager especially, you also look at it from the perspective of root cause analysis. So if we have gone overboard, what had gone wrong? Was our budget prediction not correctly calculated, or was there another reason for the actual cost to be significantly higher than the budget? So a finance manager will probably just look at it from an extra spend. But what is the reason for that extra spend? Has there been changes in external factors? If you talk about capex, has the raw materials gone up? Cement prices gone up in construction industry? Petrol prices are impacting your raw materials. So those kind of risks will highlight where you need to put in additional checks, uh, where you can put in additional controls. So this is a very basic example, and every company uses it, but it uses it from the financial context and not from the risk manager's context. But this is actually something that even risk managers use a lot. They look at the budget versus actual a lot of times and use it for various purposes, and it is nothing but analysis of the data. And similarly, you look at trends, you compare trends from last year to this year, you compare trends from overall, and not just in finances. Like I said, I was looking at risk analytics when I was part of the RBS group, and we were creating risk profiles for various departments. We were looking at a lot of factors to identify the trends in terms of risks that each department was moving into, and a lot of factors were employed. What were the number of internal audit items that were still open, the number of audit items or the action items that are overdue. Then we were also looking at how many near misses each department has identified. We were also looking at self identified issues or findings or risk assessments performed, and we were assigning scores and weights to all these kind of risk tools employed by different departments, and we were creating risk profiles, and we would create reports for Meera Sanyal ma'am with trends that arrow up would show that the risk has gone up or the risk has gone now. And these arrows in the trend were also color coded. Is it supposed to go up? Then it's a green arrow. If going up is a bad sign, then it's a up arrow but a red colored arrow. And then there was a stagnant risk profiling kind of stuff where we would show a flat line. And it was very interesting. They were using it a lot for kind of decisions that people at our level at that time, I was just a manager, we would not understand. But when you actually looked at a lot of things, they were actually using those reports, the comparative analysis, etc., for a lot of decision making at higher level. I already gave an example of trend analysis, but trend analysis is a very important tool used by a lot of companies. Trend analysis may be, in fact, the most important type of data analysis for risk managers. It allows you to diagnose what caused a situation and prevent it from recurring. It can also help you identify a link between seemingly unrelated incidents. This will allow the risk management team to implement a mitigation strategy or create more positive culture and save money as well. So, in the same example, the departments were among themselves competing to show better risk profile, and it was creating a very healthy risk culture in the organization as well. They were trying to identify more and more near misses. They were trying to come up with more self-identified findings and action items. We had what we called surprise checks, and they were trying to ensure on a daily basis that if a surprise check happens today, we get zero observations. And it was creating a lot of healthy culture, and they were getting commendations for improving their risk profile, which was visible through trend analysis over time. And that's why I said it creates a more positive culture and saves money to the organization as well. And last type of data analysis that risk managers use is visual analysis. While perhaps not a type of analysis on its own, visualizing other kinds of data analysis can be an extremely valuable process. uh, Putting data into a visual form, such as graphs, allows you to immediately process what is going on. It can also help you identify patterns that might not easily be spotted in terms of tables and all. So, like I said, we were running SQL queries, but we were giving a visual presentation of those data analytics to the managers by using Power BI dashboards. We were using a lot of graphs and charts for all these reports. And that is again, sometimes by just running the reports, you're not able to analyze the data as much as you can look directly in a visual presentation. So risk managers definitely use that a lot. We can go to the next slide, please. So like I said, the type of analysis that you should use really depends on the need of your organization. And now, why all risk managers should use data analysis, which is the big elephant in the room. Why are we talking about all this? What help does it provide to you by using all these data analytic tools? So analytics basically turn your data from useful to extremely effective and allow you to make changes that will benefit the company. If I give you a brief trivia, a survey by Deloitte found that 55% of organizations believe that analysis improves the organization's competitive position. And 96% agree that it will continue to become more important over the next 3 years. So that is why data analytics is touted as, call of the present times. So basically, there are 5 reasons why risk managers should use, and they do use, data analytics in their uh, framework and different processes that they have built in place to identify and manage risks. Uh, First of all, it prevents repetitive losses. Analytics allows you to identify trends and red flags that could become issues and implement strategies to stop them before they cost you money or incur losses, or even sometimes or even before someone gets injured. uh, I often give the example of health and safety over there. I work in the manufacturing industry. Health and safety risk is one of the biggest risk for us. And we talk about something that is called Heinrich 300 to 29 to 1 model, whereby Heinrich, he suggested that for every 300 near misses, there will be 29 minor injuries and one major injury. Now, if you analyze the data of near misses, we actually encourage people to bring to the fore near misses. We recently put in a reward and recognition program to report near misses. And if you identify or you analyze the data of near misses correctly, you can actually prevent minor and major injuries. So that is the whole idea about having data analytics put in all kind of spheres. Even in the health and safety department, we are using analysis. We are maintaining trackers. We are putting in near misses. And if I give you an example, why we are so focused on near misses. For example, someone slipped on a floor. There was something over there. He escaped injury, and so he didn't report it. Probably tomorrow, someone can actually slip at the same place and have a major injury. So if I have a person who is reporting a near miss, we are actually looking at all the root cause analysis or what could go wrong. We are looking at risks that are arising out of those near misses, and we are ensuring that the same thing doesn't occur again. So if I know that there is this area on the shop floor where the floor is slippery for whatever reason, for because they're working on some material which causes the surface to be extra smooth or something, we'll probably cordon off that area from manual usage, or we'll probably put in something else to identify that there are no slippages and the area doesn't cause accidents. So that is the relevance of employing analysis on anything as simple as reporting of near misses. The next one is more from financial perspective. It improves insurance premiums. Uh, I don't know how many people know companies in the US often demonstrate to the insurance companies. They give them data analysis and resulting mitigation strategies that the organization uses to get competitive rates for insurance. So if you're able to demonstrate that you have data proving that you are managing your risks, they actually give you better insurance premium rates. So insurance companies basically want to insure organizations with what they call good risks, which basically means that the organizations are likely to pay more in premiums than they require for loss coverage. So being able to prevent repetitive losses means lower premiums for most companies in US, and they use all these data analysis and reports and present them to the insurance companies to get better insurance, lower premiums for insurance coverage. The next one is data analytics helps you to improve reporting. With more in-depth and data analytics, one will be able to report on any relevant factor in the organization or industry. Analytics help diagnose the issues in the organization and how to fix them. So data should be actionable. Uh, it should be easy for anyone to understand and able to support business idea or risk mitigation strategy. And that is how it improves reporting. So you need to uh, present your data in a way that if for example I can use my data analytics results, so reports and different kind of things, to convince management of why some actions need to be taken to mitigate some risks, or why some actions are not working, something they are doing is not working in terms of risk mitigation. So risk managers can actually use them as a backup for their recommendations to the management. Again, it helps you to monitor performance, which is almost self-explanatory, but I'll still explain it a bit. Regular and consistent analytics allows the organization to constantly understand how they're doing, whether the internal controls put in place are functioning or not. Managers will be able to hold all departments accountable for performance and adherence to defined procedures by recognizing the goals that are not met or the red flags that suggest need for adjustment, or discovering strategies that are not working. So, uh, through these data analysis reports and analytics, after employing analytics, you're able to identify, say, key risk indicators or even key performance indicators, not just for risk managers, but key performance indicators. And it helps you to identify how the department is doing in terms of operations and how the department is also performing in terms of risk management or risk mitigation. The last reason why risk managers use data analytics is forecasting and decision making. Comprehension of what went wrong historically lets you prepare for potential incidents. I already gave the example of near misses and studying them to prevent future mishaps. Of course, there's always a chance of an unexpected event, but a thorough risk plan based on analysis of past trends helps the company to be better prepared for almost anything. Like I said, our risk reports were used by the senior most people in RBS for decision making. Our continuous monitoring reports were used by the executive board to identify where the controls are not working in home credit. In MMTC-PAMP, we also use reports and run tests to make sure that our health and safety guidelines are being followed, that the noise pollution is under control, that we are able to consistently bring down the number of operational risk incidents by ensuring that the controls are functioning properly. We are automating right now our IFC, so even the red flags will come up on a monthly basis and not just at the end of the year when the ship has already sailed. So these are the kind of checks and balances that we are already putting in place for risk management purposes. Next one, please. So how the risk managers can actually embed data analysis steps, data analysis in their day-to-day processes. So there are basically 6 data analysis steps that the risk managers need to perform. When you go through it, it appears very simple. It's not as simple. Data analysis can be difficult, especially for organizations with a lot of data and complex processes. However, when I put a 6 simple step processes or a guide to go about it, it helps you understand the chronology that you need to follow in terms of starting to, especially when you're just starting to move to data analysis. You already have a lot of manual checks in place, but you're trying to build in substantive testing and all. That is where these steps will help you to use data analysis effectively in risk management. The first step obviously is gather data. This seems like a very obvious thing to mention, but actually this can be the most difficult and time consuming part of data analysis. It's important that the data collected is valuable. And when I say valuable, I actually mean it must be accurate, it must be reliable, it should be complete and up to date. So this process, the getting valuable data is actually the challenging part over here. And if performed manually, there is always a risk of human error, and that there is a risk of time consumption. So these risks are omnipresent. So oftentimes it happens by the time you gather data, the data itself is of no use to you. So you need to focus your energies on gathering data within a certain time frame and ensuring that the data is actually correct, reliable, and you can actually draw valid information from it. Now, once you've collected the data, the next step is determine what part of it is relevant for your purpose. So, for the exact context that you're trying to build checks on. So, determine what data is relevant. There is often an issue of data overload, which leads to management receiving too much information to making them unable to use it effectively for decision making. Not all numbers are relevant for risk management. For example, to determine probability of a risk materializing, the value of loss coming from an incident is not important, and instead the frequency of the incident occurrence is relevant. When you draw a report of, for example, saying one category of incidents, for example, if we talk about customers suing you for some kind of loss, when I'm talking about drawing information about the probability of the risk occurring, it doesn't matter to me how much amount the customer has sued me for. What matters is how many customer complaints or the how many customer legal actions have been taken against me. That will help me identify probability more. The value of the complaints that have been lodged against me will help me assess the impact. But then I need to determine what I'm trying to do right now. Am I trying to determine probability? In which sense the number of complaints is important? Am I trying to predict the impact? In which sense the value of the complaints is important? So, and both together will then help you identify the risk rating of the risk of receiving customer complaints against the company. The next step is to choose a time frame. A time frame is very important for making data analysis relevant. The question is last 6 months or last 5 years. For the risk, if the team is looking at risks, for example, they're looking at risks arising out of recent regulatory changes. The data before the regulation came into force is not really relevant for me. But then again, maybe the team needs to look at the trends and identify what are the chances or what are the impact, what is the going to be the impact of this regulatory change on me basis the number of times the similar incidents have happened in my company. In that case, maybe I need the old data more than the new data. But if I'm looking at what new controls I need to build in the current system following the regulatory change, then probably only the data after the change has come into place is relevant for me. So you need to choose a time frame basis the context for which you're trying to analyze the data. The next step is the basic one. You need to run a data analysis eventually. Inputting and formatting data into visual form to make it readable and understandable is it's difficult and time consuming. One needs to keep in mind that after all the data is collected and identified and put together in a report, like I said, gathering data might take time. Is it that after you have done all this, the data may no longer be timely or relevant? So one needs to take care of what level of in-depth analysis is required. Am I going too deep and I'm taking too much time so that the whole exercise becomes redundant? Maybe a quick high-level analysis will give me the desired result. I don't need to go do very deep dive into the data that I've collected. Or maybe it is a long-term thing where I'm looking at the granularities of risks that I need to put actions in place. And in that case, I need a real deep dive. Then probably I'll use complex analysis and statistical checks, etc., on the data and come up with something, maybe quality check, Six Sigma kind of results. Or so that is something, again, the risk managers need to decide on basis the context of the purpose of the data analysis. After you've run the tests and you've pulled out the reports and the trends that you need for the risk related decision making, you need to study the reports and take actions. When you look at the results, one needs to determine whether trends are related and if they stay the same over a period of time. Consistent patterns identify areas where one may need to make changes. Most importantly, you can use your analysis and leverage it to communicate and make recommendations. Like I mentioned that you can get a management buy-in for your recommendations by backing it up with data analysis and reports. You can get their cooperation so that actionable information can be put across. So that is again where results of the data analysis or reports help you as a risk manager to get management support. And last is monitor and repeat. Data analysis doesn't end with one report. You need to keep running checks to ensure compliance with actions and validity of controls. You can continue to use it to process improvement and for better decision making. So that's something where those are the steps that risk managers need to employ to actually use data analysis to their for the purpose they need, and to actually help in the risk management framework. And I go to the last part of my presentation, and then I'll open the floor for questions. The last is the road ahead for risk management and risk analytics. I believe even after 20 years, risk management is still in its infancy stage and has a long way to go, especially in the face of rising challenges and complex industries and emerging sectors of business and all. This means that various companies are still evolving. There are new industries coming up, new service sectors coming up, and this will lead to emergence of even more detailed data. And with the technology coming into daily functioning of the corporates and all, we are reliant totally on data, and the reports are becoming sophisticated, complex, and these are to be designed in a way that actually meets the challenges of these industries. For example, banks are required to conduct regular and comprehensive background checks on customers, and at the same time prevent issues related to money laundering and thefts. And nowadays they are reliant on technology and information available to them through IT related sources, and that's where data analytics comes into play. With big data technologies, there are multiple opportunities for analysts to help the industry uh, uh, in using scientific, easy, and uh, you know data driven analysis and help in reports. With opportunities to address these challenges in real time, these techniques can help companies to reduce the risk, improve risk coverage, and provide stability to the companies as well. Because just like risk management is being embedded in every part of the organization, data analytics or risk analytics is being embedded into every part of the risk management. So both are going hand in hand. And as risk management comes into becomes stronger and stronger in terms of helping the organizations achieve their objectives, so will the risk analytics growth will also happen in the same trajectory and function, and they'll also go hand in hand in helping the companies achieve their objectives. So that's my assessment of how important risk analysis is for risk management. I would open the floor for questions now.
Yeah, sure. Nishtha, thank you very much. While you're speaking, it will bringing back a lot of sweet memories. My
Yeah.
partner Manish and me, we started off by learning risk management from Dr. Dale Cooper in the Gulf. Working for a large oil company.
Okay.
So
Okay.
since
Wow.
Dr. Dale Cooper used to run a lot of simulation studies, almost 25 years
Yeah.
back. And he used to run
Wow.
Monte Carlo simulation and others, to look at the oil fields and, what are the risk and so on. So advanced mathematical models he used to run, which is all based on data analysis and analytics. So,
Yeah.
it was very interesting as you took us through the entire journey life cycle from risk identification to reporting,
Yeah.
reporting in the form of visualization, because that would be appreciated much more by the top management or
Absolutely.
the decision makers who can actually take decision on that, uh,
Yeah.
because presented properly, it's different. And with a maze of data, it's very difficult for a top management, get a top management view in few minutes, or few, hours to understand what has happened and what is going to happen. So,
Absolutely.
very, very interesting. I told you at the beginning that this was a different analytics session, because risk management always uses analytics, and you have beautifully explained it in all the facets, elements of the risk management cycle, for
Yeah.
a enterprise. And I think the same goes for the IFC also. When we look at the risk and
Absolutely.
control at a transaction level, rather than an enterprise risk management level, there also the principles remain the same. So there's a lot of
Every aspect of risk management.
every aspect
Every
of risk
aspect.
management, it remains the same. So it was,
Yeah.
thank you very much. It was wonderful. And I think there are two questions which have been put up.
Sure.
The first one is by our dear friend Satish Shenoy, where he says, admittedly, it is difficult, we understand, but for a company, how can a risk manager have a single view of risk? So can you throw some light on that?
I'm not sure what, Satish, would you be able to explain what you mean by single view of risk,
Means
probably?
a sum total of everything, for a company, whatever the risks the company is facing, external, internal, so what's a single view?
Yeah,
How do
so
you?
we in all the companies nowadays we have started maintaining risk registers, which puts all strategic level, technology level, even process level risks together at one place to analyze, and data analysis is used in assessing individual risks as well as overall risk analysis when we are looking at risk appetite as well, where we are plotting all these risks in terms of impact and probability on a risk heat map, and that it gives you an overall visual view of risks existing in the company. Now, normally when we are doing a comprehensive risk enterprise-wise risk assessment, where we are putting in all risks at one place, we are looking at what we call inherent risks, and then we are also looking at what is residual risks, and we prepare two risk heat maps together, which actually gives you a view of what are the actual risks the company is facing, and what is the risk that is currently existing in the company after building in all internal controls in place. Now, where you put individual risk on the map will use a different set of data, and where you are building in the risk profiling of the company, that would entail a different kind of a risk analytics, but it gives you a comprehensive view nevertheless. I
Okay.
hope I've answered your question, Satish.
Yes, I
Not,
think, thank you,
not
Nishtha, that
sure.
answered my question. There are two more questions. I'll take
Sure.
Sanjeev Koshy's question first. Are web scrapers and data ingestion tools, which you talked about, effective considering the cost and resource requirement, are being used in organizations, or still they're buzzwords?
Uh, Honestly, like I said, they are in a very nascent stage right now. Not many companies are using it. I've only, as far as my experience goes, I've usually seen huge MNCs using it at a global level rather than at local levels, and especially Indian companies, they're not using these tools too much. Most of them are still reliant on visualistic tools and trend analysis and comparative analysis rather than actually using these kind of tools. But yes, there are companies that are heavily dealing in derivatives and stuff like that, that do these kind of deep dive analysis and use these kind of tools, but normal companies are not using. But like I said, it's still in growing stages. As data becomes more and more complex, probably they'll become more popular.
Yeah. Just to add, Nishtha, what we find is that when we go to companies in India, a lot of multinational companies in India are using these for looking at their reputation or what is being reported
Yeah.
about them on the web. So they are
Yeah.
not actually using it for risk management, but this is some form of risk management.
Yeah.
They're trying to look at
Like
what is their reputation, what is being
if I
reported about them in the media. So
Yeah,
they're
so
just
for
trying to.
example, if I give my current example, we do world checks on all our customers. So world check for me is part of my KYC checks.
Right.
I'm in a precious metals industry, and we are always running the AML fraud kind of risk. So the world check for me is one of the most important due diligence checks, but that is the only thing we're using it for, to see whether the directors of the customer company and all, they might be involved in some other frauds and things like that. But that is the only use we're putting it to. We're not using world checks on anything else.
Sure. There's one question by Rajesh Chakote, a practicing chartered accountant from Bombay, where he's talking about, can you explain near misses? You did explain near miss in terms of slipping of a person slipping
Yeah.
on the floor and talking about it. But still, his question is, can you explain what near miss with some more examples,
So I already gave an example in terms of health and safety, where near misses can be small mishaps. If I give you a very basic example, day-to-day life, not related to corporates or professionals, the most common example we use for near miss is when you're driving on the road. You probably, almost every day, you might escape a little scrap from there. Time pe brake laga diya and all. Those are near misses. Nothing happened, But if your attention would have probably 2 seconds late or something, an accident could have happened. So those are near misses, and it is said that after every 300 times you apply the brake on time, there might be an instance where you will not apply the brake on time and you'll meet some small accident maybe. And after 29 small accidents, there is a chance of, God forbid, major accident. So you should learn from your near misses and try to drive safer. So that's a day-to-day life example. But if we talk about near misses, I come from banking industry, financial sector industry, where we would identify near misses as simple typographical errors. For example, a Swift transaction had to go through, but a typographical error was done by the person, but the checker identified it. So that is a near miss for me. A minor incident is when the transaction has already gone through with the wrong message, wrong Swift code, but we were able to stop it on time by intimating the other bank. And a major incident is when it has actually gone through to a wrong account. So that is again a near miss. I already gave an example of health and safety where you're like slipping on the floor and stuff like that. I hope that answers.
Yeah, sure. Thank you very much. Rajesh is saying, Nishtha, just to add, just to ask you, usually find in industry, in manufacturing as well as in the banking industry, that the risk incidents do get reported, but near misses are not reported to the full extent.
Yes.
So it's very difficult to get anybody to report a near miss.
So
how do you go around that, and how do you build a database for near misses?
So like I said, I come from financial sector industry, and RBS near misses was part of our culture. Everyone was reporting that. I come from home credit, where we actually had to build that culture by putting in a lot of policies related to self-identification of risks. And usually when you tell people to identify issues on their own, they look at where they could have gone wrong. And that is where near misses come into play. You need to explain to them what a near miss can be and how it will help you identify actual risk issues. Now I've joined this company, MMTC-PAMP, where it's a manufacturing setup, and near misses in a manufacturing sector is really important. It's not just about financial loss. It is about putting your employees at risk. So here we're taking it very seriously. We tried to encourage people to report, but we were not getting desired results. So very recently we launched a rewards and recognition program. So every month, the person who reports the most near misses, his name is displayed on the board, and then probably they'll be building in some quarterly rewards and things like that. And it's been 3 months, and we have started to see a progressive reporting of near miss. I hope it becomes a risk culture just like we used to have in RBS.
Okay, great. I think, Nishtha, I don't find any more questions, and people are very happy. They've just said great, good. So let me end the session. We are right on dot. We have exceeded a time by 5 minutes, which is good. So it was an interesting session. So let me just thank you on behalf of Sama Audit Systems and Software Private Limited. We are very thankful that you came in today. A very good session, excellent session. How you relate data analytics to data analysis and analytics to risk management life cycle. And I think all of us, whether we are internal auditors or risk managers, we employ these techniques, because risk is being looked at by almost everybody, including the process owners. Though they may not be talking about it in that parlance, but every risk owner, when he takes a decision, he's talking about risk. He's looking at risk and then taking a decision. So thank you very much for this such a difficult subject being presented so simply. Thank you very much, Nishtha.
Thanks for inviting me. It was a pleasure sharing my experience with everyone, and I hope it helps other people as well.
Sure. And this will be there on the YouTube channel of Sama. So people would be looking up to this. And to all the wonderful participants who joined in, thank you to all the participants. And we will meet again next Wednesday at 7 p.m. for another edition of Analytics Wednesday. Thank you, Nishtha. Thanks a lot.
Thank you. Thank you.